This is an Uncovered Japan company research report on Namura Shipbuilding, ticker 7014. Namura is a Japanese shipbuilder that has gone from 6 years of operating losses to a high-margin, cash-rich position. The essential question is not whether the turnaround happened. It did. The question is, how much of this unusually strong shipbuilding cycle is already reflected in the share price? The starting snapshot captures the tension. Namura trades on roughly 13 times forward earnings and about 2 times book value, while its FY26 return on equity was 15.8%. More importantly, the company has roughly 440 billion yen of orders in hand. That is substantial visibility for a shipbuilder, but it also helps explain why the market no longer values the shares like a distressed cyclical. At its core, Namura builds large commercial ships, especially bulk carriers, in Japanese yards. That is the cyclical engine. But this is not only a new build story. Through SSK and Hakodate Dock, it also repairs and maintains ships in dry dock, while a smaller other segment includes naval vessel maintenance for Japan's Ministry of Defense. Those two activities do not remove cyclicality, but they provide useful ballast when new build prices eventually soften. The financial reversal is stark. Revenue climbed from 83.4 billion yen in FY22 to about 159 billion yen in FY26. Operating profit swung from a 9.5 billion yen loss to 28.1 billion yen. Net income eased in FY26, but the report attributes that largely to a normalized tax rate rather than a deterioration in the operating business. The improvement came as low-priced legacy orders cleared and higher-priced work entered production. The segment picture explains the business model. New shipbuilding represented about 77% of sales and produced a 22.4% segment margin in FY25. Ship repair was roughly 14% of sales, with a 15.8% margin. The smaller naval and related segment matters strategically because defense maintenance demand does not track freight rates in the way commercial new build demand does. Still, new shipbuilding determines the earnings outcome. Nomura's advantage is best described as visibility. Its backlog is roughly 2.5 to 3 years of contracted work, much of it priced in the current favorable market. Repair and defense work add durability, and management is using the cash-rich period to automate and lower the break-even point. The crucial caveat is that shipbuilding contracts are often fixed price and long-dated. Steel costs and exchange rates can still move against the company before delivery. The balance sheet is materially different from the last down cycle. The equity ratio doubled to 50%, and the report records 90.1 billion yen of cash against 17.7 billion yen of debt, leaving Namura effectively net cash. That does not guarantee the share price in a downturn. It does mean the company is better placed to endure one and gives management more flexibility than a typical shipyard has had at the peak of a cycle. Cash flow confirms the repair in the balance sheet. FY25 operating cash flow reached a record 37.7 billion yen, and free cash flow was 32.5 billion yen. That cash funded the balance sheet recovery and dividend growth. But this is one place where a cyclical investor needs nuance. A full order book brings advance payments from shipowners, which boosts current cash conversion, and can reverse when the backlog thins. The macro backdrop is unusually favorable. Shipping's decarbonization requirements are driving replacement demand, while a weak yen improves the competitiveness of Japanese yards. Higher Japanese defense spending supports the SSK maintenance business. The longer-term test is whether Namura can use today's cash generation to win next-generation fuel ship work and improve productivity before the new build market turns down. Valuation is where the story becomes less comfortable. Namura's trailing price-to-earnings ratio has re-rated from 4.7 times to around 13 times. The report considers a forward range of roughly 12 to 16 times fair, rather than obviously cheap or expensive. Because the full backlog supports earnings visibility, but the underlying business remains cyclical. The shares are no longer priced for a turnaround. They are priced for continued solid execution. The scenario analysis makes the asymmetry explicit. At the report's 4,120 yen reference price, the 3-year base case is 4,095 yen, effectively unchanged. The bear case is 1,850 yen if margins and the multiple both compress. The bull case of 6,427 yen requires the favorable cycle to last and next-generation fuel ship work to support margins. These are research scenarios, not price targets. Their value is in showing which assumptions investors must monitor. Namura Shipbuilding is a genuine turnaround with a rare combination of multi-year work visibility, a net cash balance sheet, and repair and defense ballast. Those are meaningful strengths. But the current valuation already recognizes a strong point in the cycle, and the report's base case sits close to its reference price. The practical watch list is backlog quality, ship pricing, steel and currency exposure, cash conversion, and whether management turns its stronger finances into a clearer capital return policy. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.